Hello and welcome again. This is Robert Schein, Managing Director and Partner of Blanke Schein Wealth Management. Thank you for joining us. Today is our Tuesday edition of Market Observations and Insights. It's the 9th of March of 2021. And if you've been following along, I'm sure most of you have. Well, first and foremost, thank you. We appreciate you. And then also sharing this with friends and family. But we've been pretty spot on as it relates to what's going on with regards to the markets, right? Remember a few weeks back when I said we're going to have heightened volatility. We're going to have increased just sort of risk adjustment and rebalancing in the market itself as we see a consolidation play out, meaning the leaders from last year are going to take a breather, think technology, coupled and sparked by the 10-year treasury, which again hit close to the last few trading sessions, 1.6%, and then now backing down. As we saw the 10-year treasury back down to about a 1.5 handle on the 10-year treasury, we now see that technology is catching a bid once again, but not before yesterday's close where we had NASDAQ in correction territory by over definition of corrections by 10%. And as I said before in the last few sessions on my daily updates, it's not uncommon. In fact, it's extremely normal and healthy to have a 10% and a 5% and maybe even a couple 5%, if you will, a correction in one calendar year for the markets respectively. Now, obviously, NASDAQ is going through a bit of a pullback, but we're also seeing the Dow Jones Industrial Average make all-time new highs. Robert, how is that even possible? Well, growth versus value. Dow Jones Industrial Average, a 30 industrial basically sector of the S&P 500 are catching a bid. Why? Because global growth is taking hold. All the stimulus and all of the reopening is now moving markets as well as interest rates. That's why interest rates are going higher, simply because the growth story is real and the reopening story is real. That's all positive news. And so what happens is that it hits technology pretty hard when interest rates go higher. Same thing with emerging markets. They're pulling back because interest rates are going higher. There's a correlation effect negatively as it relates to that. But we believe that the 10-year treasury is sort of a temper tantrum playing out. So it's previewing what's going to happen maybe later half this year, maybe even to 2022, but we just got a picture preview. So we're going to see the rotation back to technology, but in the meantime, we saw industrials, financials, energy catch up, as I said before, and that was really critical because you want not a narrow bull market, you want a broad bull market, so you need all sectors. Even real estate REITs are catching up year to date as well, and that's healthy as we see this. Now, it's not uncommon to have a 10% correction, but still have a positive year as it relates to markets. If we look at history as a guide, again, there's not a prediction here, but at the same time, history is a very good sort of indication of what we could expect. And sometimes it actually matches up pretty well. We shall see how this year plays out, but I had some samples here, historically speaking. So best growth years are also see a 10% correction. If we go back to 1984, 1985, we had 1984 in the S&P 500 was positive by just over 6% in that calendar year in terms of the performance of that index, and followed by 1985, a plus 31% on the 1985 S&P 500 performance. All the while, 1984 had a 14% correction in that year. And if you look at 1950, 1951, same thing. 1950, we had a 14% correction in that year. But the S&P was positive, well over 31% for that year, and then followed the next year. We had an 8% correction in 1951 on the S&P 500, and still the market was up by 18+% in that calendar year. Why that's important? These are years and sample sets that we had the GDP growth of well over 7% respectively in these periods of time. So meaning they're coming off a recession, there's a lot of stimulus, a lot of support, and there's growth sort of on the horizons, both in US and globally speaking. And this is sort of how they ended up. So we are in the same setup. That's why we selected these years. And we do have GDP roaring ahead as we have that 1.9 trillion stimulus. Now, there are also 92 million reasons to be positive. As the most recent report, right now we've had 92 million Americans vaccinated. since the vaccination rollout, and we're averaging about 2 million a day. Now, there are 330 million Americans in the United States, and a third of them are under the age of 30. So right now we're charging and forging ahead, and what the markets are seeing as they do these short-term corrections, but long-term, very positive for markets, simply because we are reopening. Vaccines are helping as it relates to that, and now we have the stimulus. Those checks are going to be in the hands of Americans, and we know one thing's for sure: when the American consumer gets $1 in the hand, do they put it in the bank? No, they don't. They go to their local, whether it be online or the local mall when it opens up again, and they start spending again. That money works its way into corporate balance sheets. And what happens? That means that corporations make money, profitability is there, and we see markets grind higher as a result. So we will pay attention to this. This is a big developing story. Corrections are normal, and that's what rotation is healthy. And we should see NASDAQ. Let's see how we play out today. NASDAQ is up big, and there are a lot of bargains out there that we're taking advantage of for our clients at Blanke Schein Wealth Management. So thanks for watching. Until next time, you guys stay healthy and safe. Take care.